If you own your home and you're over 60, there's real movement happening right now that could affect your property tax bill, some of it in Washington and some of it in state capitals across the country. I want to walk you through three things: what's actually confirmed right now, what's still just a proposal, and one detail almost nobody talks about that could save you thousands of dollars this year alone. No new law required. First, let's clear something up because there's a lot of confusion out there. There is no new federal law that creates a nationwide property tax break just for homeowners over 60. If you've seen headlines suggesting Congress passed something like that, that's not accurate. Property taxes are collected locally by your county or your city, and Congress doesn't have the authority to waive them. What Congress can do, and has done recently, is change federal income tax rules that affect how much room you have in your budget to pay those property taxes. That's an important distinction, and it's one insurance salesmen and clickbait channels love to blur. If you're 65 or older, you already qualify for an extra standard deduction on your federal tax return. And for tax years 2025 through 2028, that additional amount is $6,000 per qualifying person. If you're married and both of you are 65 or older, that's an extra $12,000 off your taxable income, on top of the regular standard deduction. Second, the cap on the SALT deduction, that's state and local taxes, including property taxes, jumped from $10,000 up to $40,400 for 2026 for people with income under roughly $505,000. That means if you itemize instead of taking the standard deduction, you can now deduct a lot more of what you pay in property taxes from your federal taxes. Neither of these lowers your actual property tax bill. They lower what you owe the IRS. Different thing, but real money in your pocket if you qualify. Now, here's where it gets more interesting because the real action for people over 60 isn't happening in Congress. It's happening state by state. And depending on where you live, this could be a much bigger deal than anything federal. In New York, Governor Hochul signed a law that raised the ceiling on the senior citizen homeowners exemption, letting local governments offer up to 65% off your home's assessed value, up from 50%. That's effective for 2026. Your local government has to actually opt in to offer the higher amount. The law makes it possible, it doesn't make it automatic. So if you're in New York and you're 65 or older, the first call you should make is to your local assessor's office just to ask whether your town or county adopted the higher exemption yet. In Texas, voters already approved bigger homestead exemptions back in November 2025, and for 2026, school districts have to provide a $140,000 homestead exemption, with an extra $60,000 on top of that if you're 65 or older or disabled. There's also a school tax ceiling that freezes the school portion of your tax bill once you turn 65, as long as you keep living there. Texas is also floating something called Operation Double Nickel, a proposal that would drop the qualifying age for some of these senior benefits from 65 down to 55. That one hasn't passed. It's a proposal, not law, so don't go planning around it yet. But it's worth watching if you're in your late 50s and thinking about your timeline. If you found this helpful so far, go ahead and hit like and subscribe if you haven't, because I'm going to keep tracking these state and federal changes as they develop, and you don't want to miss the updates. New Jersey has its Stay NJ program, which can knock up to $6,500 off your property tax bill if you're 65 or older, have lived in your home at least a year, and your household income is under a fairly generous cap. There's also the older Senior Freeze program, which locks your property taxes at a base year amount so they don't creep up as your home's value rises. The mistake people make here is assuming these programs stack automatically. They don't. You typically have to apply for each one separately, and the paperwork deadlines aren't always the same. Their senior exemption is available starting at age 61, and it also covers people who retired due to disability, plus veterans with an 80% or higher service-connected disability rating. There's a separate deferral option where the age threshold is 60 that lets you postpone your property taxes instead of paying them outright, with the deferred amount collecting simple interest over time. That's worth understanding carefully because a deferral isn't free money. It's a loan against your home that eventually needs to be settled, usually when the home is sold or transferred. Some retirees jump at a deferral without realizing it, which can complicate things for heirs later. There's a citizen-led ballot initiative called the 60 Plus Property Tax Exemption Act of 2026, which would exempt a primary residence from property taxes entirely if the homeowner or their spouse is 60 or older and has lived there as their main home. This is not something Congress did, and it's not even something the California legislature passed. It's a proposed constitutional amendment that needs close to 877,000 valid voter signatures to even make it onto the November 2026 ballot. If it qualifies and voters approve it, it would be a massive change. The fiscal analysis suggests it could reduce local government and school revenue by 12 to 20 billion dollars a year, which tells you how significant the exemption would be. The benefit almost never applies automatically. You have to know it exists and you have to apply for it yourself. Nobody at your county tax office is going to call you up and say, "Hey, you qualify for this." That's on you or on someone helping you to go find out. Now, here's the part I really want you to catch because it's the one thing that trips up more people than anything else I've covered so far. And it applies almost everywhere these senior exemptions exist. Many states don't count all of your income the same way the IRS does. Some programs exclude a portion of your Social Security benefits from the income calculation. Others exclude certain medical expenses or unreimbursed caregiving costs before checking whether you're under the threshold. That means you could look at the headline income limit, assume you make too much to qualify, and skip applying, when in reality, once the state's specific formula is applied, you'd actually qualify with room to spare. This single misunderstanding causes more eligible seniors to leave money on the table than almost any other mistake I see. Before you rule yourself out based on your gross income, pull up your specific state or county program's definition of income and read it carefully, or call the office directly and ask them to walk through the calculation with you. There's also a common myth worth clearing up. People assume a senior exemption and a basic homestead exemption are the same thing, or that one replaces the other. In most states, they actually stack. You file for the homestead exemption first, since that's open to any owner-occupant regardless of age, and then you layer the senior exemption on top of it for additional savings. If you've never filed for your basic homestead exemption, that's the first thing to fix because it's the foundation everything else builds on. There is no federal bill from Congress creating a nationwide property tax break for homeowners over 60 right now, despite what some headlines might suggest. Though real federal tax changes, the bigger standard deduction and the higher SALT cap are already helping seniors keep more of their income. The real tangible action is happening state by state in places like New York, Texas, New Jersey, Washington, and pending in California, and it's worth checking what's available specifically where you live. And the single most important takeaway is this: these benefits are not automatic. If you're 60 or older and you own your home, the one action to take today is to call your local county assessor's office or check their website and simply ask two questions. What senior exemptions or freezes do you offer, and how is income calculated for eligibility? That 5-minute phone call could be worth hundreds or thousands of dollars a year, and it costs you nothing to ask. Take care of yourselves, take care of your homes, and I'll keep watching this space so you don't have to. See you in the next one.